All right, so we are live on the Phoenix RIA. Our Facebook page is my Facebook page, Luke's Facebook page, and then we are live on the YouTube channel Just for Flips and the Viking YouTube channel. I'm here with Luke as always.
Oh yeah.
Today we're going to talk about creative financing. Eric, who is our guest, is running just a hair behind. So when I see his little thing pop up down there, I will, get him in. But to just start us off, I'm going to. Eric is here, so
look at that. What timing?
Add to stream. What timing? I was just saying Eric wasn't on yet, but now Eric's on, and
there we go.
So I'm gonna go and start a. Actually, I'm gonna let Luke start us off because I'm not plugged in, and my battery light we got technical difficulty. My battery light just said you got 5% left. So since I'm the one hosting this, I better plug in.
Hey, you go get plugged in. So for those of you that don't know Eric is a just absolute stud, creative deal maker. Eric, I think I always knew that we were destined to do stuff together because your last name is my wife's first name. I don't know if I told you that.
Your wife's name's Sage?
Yeah.
Yeah. That's why we couldn't be together because that would be awful.
Sage is a it's an interesting name.
I did date a girl and after college her name was Paige and she said that either, so
that would have been good. Paige Sage. I think it's got a little ring to it.
Well, but I ended up marrying a Canadian, so it's fine.
All right, there we go.
I'm just going to jump back in and just, if you guys haven't noticed, the market is moving. Inventory is coming online. Looked at the Crawford report. We had the most pending sales in a week since, I think, in like 6 months over the last week. So people are out there buying. The 10-year still at 3.5. So interest rates are, like 5.5. I see people all over YouTube and social media like, hey, how to get a 4.5% mortgage. I'm sure if you follow any real estate guys, I'm sure you guys have all seen it too. That's right. Just using a 2-1 buy down. And if you buy down the rate, you can actually have a 4.5% mortgage. Now that's only going to last for a couple of years, but
right.
You can actually get a 4.5 mortgage in this market. Actually, I think I saw it on Bigger Pockets. They were advertising the 2-1 buy down. But we are here with Eric, and he's gonna talk to us about a specific strategy on how to basically make $50,000 out of thin air, right?
Yeah.
I like that.
How about $102,000 out of thin air? How about that?
Hey, that works too.
I don't want to set everybody's expectations like too high.
Too good to be true. You can't do it. It's too good to be true.
Take either one of those right now.
Yep. So tell me, you want me to go in and do a little intro on who I am, what I do, and how I do it, or what?
Yeah, just give us a little intro, and then just talk about, if you want to talk about the $102,000 deal, great. Or if you just want to talk about a hypothetical deal, great. But yeah, let's talk. The title of this show is how to make $50,000 for free with creative financing.
Wow,
that's what I titled it.
Oh, okay. There you go. Okay. So
I'm going to be taking notes again too.
Yeah. Quick background is I've been buying and selling houses in the Phoenix, Arizona market and nationwide since 2004. I got my very first deal, door knocking, a pre-foreclosure, bailed people out of their house. I bailed a client out of their house that their house was in bankruptcy. It got discharged. And they didn't know it because that's what happens sometimes when you're 18 months behind, you go through a bankruptcy, then it gets discharged and it can go right into foreclosure the following business day, which that was a Friday. It was a 3-day weekend. So long story short, we bailed them out of we got them out of their foreclosure. They were $58,000 behind on their mortgage. We bailed them out. And we did a lease purchase with them. We don't typically do that strategy anymore. We do it a little differently now, but it's a pretty cool story that client that we bailed out back in 2004 is still living in that house today.
That's awesome.
So that that's what people always talk about our real estate guys, that we're just beating people up and trying to take their houses. That's not true. So anyway, so now fast forward to 2022. Well, actually, 2023. Sorry, we're all, almost 20 years later. We're back in that realm where we have the opportunity to take over people's mortgages and do creative financing and stuff like that. And so now what I do is my main business is I like to find wholesale houses. It doesn't have to be a wholesale house, but that helps. If I'm going to pay cash or use private money to fund a deal. And then I flip the properties to a seller finance buyer, someone that's unable to get traditional bank financing.
Yeah, we'll just call them penalty box buyers, right? They're penalty box.
Yeah. What
are we? A guy that owns a business that filed bankruptcy 2 years ago, something like that. He can't.
Right.
Or they're foreign nationals.
Yeah, or foreign nationals.
So they have an I-10 number. They pay taxes. They're just not able to get traditional bank financing from a traditional bank because they're no credit, not lack of credit, just zero credit because they. Yeah. And so now what I do is I find typically median home price houses. They might need a little bit of fix up, a little bit of TLC, which we all know. Luke is the master of renovations, and I just don't like to do it because it takes time, and I'm not great at it. I don't have the vision like you do, and so I'd rather just find a good deal and pass it on to a seller buyer, and then place myself in the middle and make a little bit of money and just do it over and over and over and over again. And so when you say the $50,000 deal, so let's think about it. So I was able to pick up a property, let's use in the Phoenix market. I'm not sure who's listening to this call, but we'll call it the Maryvale area. And if I'm able to pick up I'm able to pick up a fixer upper for around $200,000. And nowadays, I mean, shoot, that was a couple months ago, so now it's probably even less. But for about $200,000, okay. This is the $50,000 free and clear deal. So I buy it for $200,000. Now that $200,000 includes my acquisition, closing costs, and hard money fees. Okay,
perfect.
Round up to 200 all in. Okay, so then I go to a seller finance buyer that's not able to get traditional bank financing, and they're going to give me $30,000 down at 280. So I'm going to go sell it for 280. Okay, and then now they owe me 250. And then so then what I do is I take the $200,000 all in cost and the total 250 that they owe me. I split it up into two separate loans. I have a $200,000 first lien and a $50,000 second lien. I sell off my $200,000 first lien to a long-term long-term note investor that wants a coupon basically that I created for a really good qualified buyer, that has income, the ability to pay, and guess what they're going to do to that house? They're going to go make that house a 350 house probably. So their loan to value off the charts. We're able to charge right now about 10 to 11% interest for that loan, which is still in line with what rents would be. With home ownership. And so where did that free and clear $50,000 come from? Well, I bought it wholesale. And then I sold it to a retail buyer that still could add value to it and have equity for their family. This particular house, I'll just off the top of my head, was a 4-bedroom, 2-bath that they'll probably turn that carport or that 1-car garage into another bedroom.
No doubt about it.
3. And so now you have this great house for a great family, and they just pay that. So the cool part is this isn't a lease purchase. Like they own the house. Like they buy it from me. They give a real down payment. They get the deed to the property. The taxes and insurance are serviced. We have a full 50-page clean package. So when my note investors want to buy the property from me or buy the note from me that I created to pay back my cost, either my hard money lender, private money lender, or myself, whoever funds the deal, they have a clean package. The notes are written the exact same every time. They're serviced probably by the same person every time, depending on what market I'm in. And then we go on and do it again. And the cool part about this deal is now I have a little more time on my hands, a little more time to sell these properties where I can get in and out of these in a couple of weeks. Because now if I have a house that's vacant I was just looking at one today. It's vacant. I could probably negotiate a deal with my seller to give me a little bit more time, and I could have this thing sold in an escrow with my, your A to B transaction and your B to C transaction. I could have everything going at the same time, and just kind of do. I could probably close it out in 2 weeks. That's from acquisition to disposition and note sale, right? Because the note sale, if we create our paper, and you guys will probably have a few questions here, but once I create the paper, I want to make sure it's closed and recorded, and that first loan, those notes that I created, the mortgages that I created are closed and recorded. So then when I sell the loan, that it's just it's a note and sale and a launch, and then I can transfer all the servicing over to. Well, I transfer the note over, and then the servicer pays them instead of me. Does that make sense?
For sure.
And for all you people so a note transfer, like you can assign a deed of trust, but when you assign a note, it's called an allonge. That's the document.
Yep.
Some people might have missed that, and you like, what did you just say? An allonge is a document that assigns a note, just for you guys.
Right. And the cool part is we have title insurance, then we have a lender's policy, and so I've been, because I teach this stuff too, right? So I've been talking to some people all over the country that are reaching out to me and asking me some questions. So I've been taking a lot of calls and having actually a blast doing it.
Heck yeah.
And so there's been a lot. the note business, there's not everybody. Majority of people do honest business, but there's some shady people out there in the note world sometimes, and they can happen. So it's been really interesting for me to talk to people that might have had an incident one way or another, and I start explaining to them how we do it. They're like, "Oh my God, this," because a lot of people are like, "Oh, how do I get a non-performing note and get a discount and go and reperform it and talk to the sellers and rewrite it and do all that?" That's no different than flipping a house. It's just flipping paper and creating and modifying. For me, I just like to make it clean from the beginning and have a good loan to value and find a passive investor that wants a good, 70, 75%, 10% interest rate,
And so guys, where this can obviously be so, beneficial is a lot of people on here, I'm sure, are, wholesaling and flipping. And so obviously, that if you can buy something at 200, which, again, let's just say realistically right now, if retail on a property is 280, like you're saying, we have many, many opportunities come up where you can buy a house for 2. Right. The thing is, though, is that for someone like myself as a flipper, or even for someone as a wholesaler, there might not be enough juice in that deal by the time that you do all the closing costs, all of the realtor fees, absolutely everything by the time you do flip it. Or if you're going to wholesale it, there's just not maybe enough for the end person, the end flipper. So it's like, if you can actually buy something and sell that at retail, which is obviously that's what so many people were doing while when the funds were here. And obviously those have been gone for a while now. So it's like, that's where you can see there's so much value, is because you're able to actually take that and actually able to, like you said, pull a 50K, a 50K deal out of that, where that's been so difficult this past 7 months, is to be able to find a large deal like that. So that's super cool.
Well, look, here's the way. I'm old. I'm 50 years old now, and I've been doing this a long time. And so it's like, my mindset is, how do I, and Chris will like this. So I've borrowed from you, and I've borrowed from private money lenders all over the city, and different people have created private lenders. And I always ask them, I'm like, hey, what were your debits and credits as a lender? And they're like, well, I get a lot of credits from you when you pay me. And then, the only debits is, the only debits is when I pay off or get my money back. I don't do anything. I don't have to worry about taxes, insurance, and maintenance and all this BS. I just I lend to good qualified borrowers. And so I'm like, gosh, I want to be in that shoe, because I want to be able to create passive cash flow. So it's funny. So that $50,000 loan, if the listeners are here, go find your trusty amortization calculator on Google or wherever, put in $50,000 and at 10.25%, and it's $448 a month. Okay. Yeah. I'm getting paid on money. So some people might, this is a good question is, would you rather have 50,000 cash or $448 a month? Well, for me, just so you know, I got 30,000 down on that property too. So I did get a little bit of cash now, right?
Yeah, exactly.
And then I got this $50,000 loan that's going to pay me some cash flow. And for me, like I live, you know, a pretty conservative life, but how many $448 a month do you need, you know, to not, because you know, we talked about this the other night. Every time you wholesale or fix or flip a house, that after you're finished, you're unemployed again. Yep, and then you got to go do another one, right? And another one and another one. Even wholesale, it's the same thing. Like you're always hustling. So my goal was, how many hundreds of these little notes can I do? And not only that, help homeowners. Because here's the deal. It's a supply and demand deal. If you guys go on MLS right now and Google or search MLS, how many seller financing houses, how many homes are listed with terms right now? I bet you it's less than 5%, and that's probably high.
Yeah,
probably. I can see that.
But how many people need seller financing in the market?
Yeah, plenty.
The majority of people need it. You know what I mean? So now we have so if you offer terms, and the majority of the market needs it, you only have one house. So it becomes a supply and demand thing. And so you get to pick and choose who the best seller finance buyer is. And then what happens is, which is really cool, is you have one house that you're offering terms to the majority of the market, and then only one sell. But now you just built a buyer's list of about 10 or 15 more people that need it, and have given you their terms and what they can qualify for and their down payment. Now you just should go back and find them 10 more houses.
I heard you say this last week, but you know, I'm sure a lot of people think like, oh, well, who's going to go out there and just pay 10, 11%? But then at the same time, it's like, you think of people that are paying 10, 11%, but guess what? They're still paying their mortgage down. They're still paying that to own a property, where there's a lot of people out there that are just renting and they would love to buy, but they can't buy maybe because of the traditional financing. So you take an interest rate at 10, 10.25%, 10, 11%, whatever it is, that's still typically going to be better than renting. The numbers on it are still better.
What's the interest rate on rent?
Exactly. There's not, right. You couldn't even imagine what that would be.
And certainty and security for you and your family. So if you're a tenant right now and you own a house and you have a place to live for the next 30 years, if you make your payment on time, how does that make you feel? You know?
Right.
It's another tool in the toolbox. That's what I say.
For sure. I got a question for you. Okay. So that first lien and the second lien, those are both at that same percent.
Mm-hmm. Yeah. And so what I do is I keep it affordable. So, I mean, you start going to $500,000, $600,000, $700,000, $900,000 price points.
Yeah.
You know, then you got to look at the math.
It's a big number.
But when I sell off my first liens, I sell them. They all come in between, depending on the loan to value, between 7 and 10%. Right. That's what my note investors want, based off the loan to value and their risk. Right. And so what I do is if I can create that first and I have a bunch of equity in my second lien, I can play around with that rate because I don't have any cost in it. But the only downside to it is if I ever want to liquidate it or I ever want to borrow against it, which you can do, you can collateralize your loans, right? And so then I'm going to get less money, or I might lose money because it is a second lien. There is risk involved, but I look at the borrower and who I'm lending to, you know?
Mm-hmm. No, for sure. So
now, where do you shop those? I mean, I know people are going to ask. I know the answer, but where do you shop those when you sell those first position mortgages to?
So I'm kind of, I would say, somewhat lazy, and I'm getting less lazy because I like to provide. I have a certain amount of people that want these that are pretty high net worth people, and they just love the coupon. They know that when Eric's notes created and the terms and the documents are done, the next month they have a coupon, they get paid. So it's kind of cool because there's a lot of people that have invested in syndications and all the, like, they lose control over their money for who knows how long, right? We know a note, if you're in a first position deed of trust at, let's say, that $200,000 number, and you're getting 10%, which I don't know what that exact number is, but you're getting that payment. Okay. And it's a 30-year term. We're doing 30-year terms, but you're just getting a coupon, but you can leverage it. I mean, or if you can sell it, I mean, it's a good asset, right? It's a stream of income without the headaches of owning the real estate and all the things that go along with that. You know, who got called from late last night when I had a plumbing issue on one of my properties? Me.
That's always fun.
No, that's why I don't do it anymore. I still have some stragglers out there, but it's like, I don't do
it. For sure. I get those calls pretty regularly right now. That's for sure. That's awesome though. I love it.
So what
So
do you?
I-
What's your,
Oh, go ahead.
What's your? So let's wander over to the subject to model, because it's really popular with a lot of people, especially on social media. It's like, I mean, creative financing that's one way that you do it. Everybody's out there talking about the subject to model because it's popular, and so what's your thoughts on that?
So I started my career with subject to foreclosure bailout. So I've been doing subject to for almost 20 years. So that's cool. So let's talk about the initial the one we just talked about. When I'm finished with that transaction and I sell off my first lien, I have zero risk. It's like the Burr model on steroids, because I don't have any more Burr. I didn't borrow anything. It's gone, right? So there's a time period from the acquisition to disposition and note sale. And then when I'm done, I wake up every morning and know that if someone doesn't pay me, I'm out on the hook for that money. Okay. So there's almost no risk when it comes to that, other than if they don't pay, you lose some income. But I do structure my contracts with my sellers or my buyers to where I might have some opportunity to buy the house back if there's a potential default, which my note buyers love because they know I'm over here trying to save my money, right? So it's a win-win, right? So let's go back to sub 2. So now you have sub 2 subject. You take over a house subject to, you have consumer A that you took over their mortgage and told them you're going to make that payment regardless of what happens. That's your obligation, Yeah. And then I go maybe sell it on terms or wrap, and I go sell it for more money and create a wrap, right? One of the biggest challenges right now in our market is people are doing these wraps and they might create just one loan, right? Well, what happens if the dang loan gets called due? Let's go back to that deal that we just did. Exactly.
Right.
Let's say now they owe me $250 and I created one $250,000 loan, but I sub 2 at 200. Okay. Now, yes, your cash flow is going to be crazy awesome, but note gets called due. If and when it does get called due, the seller decides 5 years later that they want that off their credit, and you have to contractually, you have nothing, you don't have to do anything. But let's talk about a consumer scenario here. You're probably going to want to help them out. Okay. So there's a couple ways to fix it. But my point is, if I created that 250 and the only way out of it is to sell it to a note buyer that wants a 70, wants the loan to value where he needs to be and his cash flow where he needs to be, I'm probably going to have to liquidate that. That I'm going to have to discount it in a way where I'm going to have to write a big old fat check, right? And so what I always tell everybody is, rather than create one loan, create two. Same thing. You're just going to wrap over the top of that first lien, create the second, just like that. And if it does get called due, sell off the dang first lien, and you don't have to discount and lose in your second. And so I like that model.
So
now, real quick, Chris. But one thing is, one of the other things is we disclose when we sell a house on a wrap with underlying debt that could be called due. It's fully disclosed. So what we do with our buyers, so we don't hurt Mr. Buyer consumer that just put their family in this house,
right?
Foreclosed on. What we do is there's contract, there's wording that you can put in your agreement. If God forbid it does get called due, we could deed it back. We can go refinance it, fix it, pay for all the fees, and not even move your family or anything like that. There's ways to do that as well. So sorry, Chris, what were you going to ask me?
Yeah. So if the note is called due, I mean, a lot of people are talking about subject to, because there's the 2.75, there's a 3, the 3 1/4, the 3 1/2, right? Well, if you got a note called due today, let's just say you wrapped it 2 years ago, and the majority of these aren't going to be called due. I've actually only heard of 2 now that have been called due, and it was because it was the little small bank that had the note. It wasn't it wasn't the big Chase that had the note. It was the little bank that obviously audited their portfolio. Whatever they did. There was a transaction, and they're like, I don't want my money out at 2.75.
Right.
But right now you couldn't you couldn't replace. You're probably at 5.5. You're double the mortgage
on a good side. Yeah.
So hey, your speaker changed. It's got like does his sound louder now? Or was it just
mine?
Yeah.
Maybe.
Extra loud.
It's extra loud right now?
Yeah.
Huh. Let me see. Maybe I need to turn this down.
Yeah.
that better?
So what do you do in that instance? I mean, it probably won't happen, but what do you do? It's because it's a possibility, and that's the only thing is like I don't do sub twos. What I've learned about government agencies and banks and all the fun stuff is if you quote unquote, like I have a banking license, I get no room for oops, I didn't know, I didn't understand. None of that works for me. So
right.
Well, how do you fix a due on sale clause? How do you fix a loan that is getting called due? You just pay it off and nobody's harmed. Would you agree?
For sure.
If you pay it off, but the majority of people out there doing sub twos, and I know a lot of them, they don't have 200,000 laying around to pay off the damn loan. They just don't. Yeah. And to fix that problem. And so, but if they were able to have a $200,000 loan and it gets called due and they cash flowed, I mean, I have sub twos. I mean, I cash flow $1,200 a month on some of these things. So there's plenty of cash flow. So I would, if I'm going to do it, I'm going to structure it in a way that where it's managed properly. I have the ability to pay it off if it does. I structure my loans properly and I write it out as long as I can and make sure I have the liquidity to pay it off if I do. And if I did, God forbid, that $200,000 loan, I had to sell it for 180. Okay. So I wrote a check for 20 grand versus $250,000 loan that I have to settle it for 180. Now that's a big number. 20 grand, we could probably figure it out. 70, that's difficult, right?
Yeah.
Yeah. And like you said, you were cash flowing that whole time too. So
yeah, like I don't mind them, but let me just tell you, like, and I like Chris's idea. It's like, yeah, the cash flow is good. Well, okay. But we have a supply and demand thing. If you just do the first and second sell, first keep the second, don't do any sub twos, and you just do more and not, because I know I have sub twos, they're still a pain in the butt, even though they are cash flowing. So what's that pain in the butt worth to me? Right now I'm going towards not having it anymore. I don't want a pain in the butt. I just want it to be clean, you know?
Yeah.
I'm going to bring up one little other pitfall just so, because the way Eric's doing it will also help in this pitfall. What happens when the occupant, new owner quits paying? If you do the wrap like Eric said at the 250 and you transferred it and you're just kind of out there, you really don't have any way to repossess the property or save the people's credit that you said that you would without writing a check for the loan. The only reason I know this is because people will go out there and do sub twos and then they sell the property and the new buyer is in place, but he quits making his payment, right?
Yeah.
Well, there's no if you don't keep yourself in the middle with Eric's second that's $50,000. Now Eric having that second for $50,000 has, because he's probably going to quit. If they're going to quit making the first payment, they're going to quit making Eric's payment too. So now Eric has a way to foreclose them out and recover the property and do this whole cycle over again. It's actually better done on a seller's contract or a land contract, because then he can actually repossess the house in about 30 days.
I like, well, sort of, because, and I own land, I have land contracts, contract for deeds, I have all of them, right? And what I've found is once people have enough equity in the property and they put enough equity down, now that equitable interest will eliminate, most judges will force you to foreclose. And that's what I do now, because I'm foreclosing. So I bought big pools of loans. I did the whole non-performing thing. What a pain in the butt. It's been profitable. It's just consuming. This other way is not. So when you brought up the, this is the other pitfall that a lot of subject to wrap guys or girls and guys are making, is they're like, you know what? I took over a loan at 2.5%. I'll just sell it to them at 6.5. That's great, right? Well, what in most note buyers don't want 6.5% returns. They want 7, 8, 9, 10% at certain loan to values. So then think about that. Think about if I created that let's say the 200 was at 2.5%, 3%, and I sold it for I created a note at 250 at 6.5%. Well, I have to go and discount that note to get the yield that the note buyer would want in order to take out that loan. It's even more of a discount. So it's really important when you create your paper But doesn't mean I can't take that 50,000 and do a 5% loan. I can do whatever I want because it's my note. But but I want to make sure I put it in a position. Chris knows as a lender, there's certain yields that you guys try to accomplish, and so I create them that way.
Now, so Eric, how do you create the two separate loans? Like, how is that done? Is it just in the contract how you draw it up?
Yeah, so I sell a property 280, and when they go to closing, they're fully underwritten, and there's going to be a first and second. It shows their payments. They're fully qualified with a licensed RMLO, and that shows their payments. And then certain servicers that I use, they'll actually collect the one payment, split it up, and only charge me
okay, that's what I was wondering.
One servicing fee, and some will charge both servicing fees. But here's what I do. My borrowers are so blessed to have homeownership. I charge them principal, interest, taxes, insurance, and servicing, PITIS. They actually pay the servicing fee. I pass that on to them.
And so what's that these days? $30?
Yeah. And if I have two, it might be an extra $15. But so I have different service. Some of my servicers, they charge two. I've had some because I had some big spreads where the buyer's like, I ain't paying the second servicing fee. I'm like, great, I'll do it. I typically don't, but it depends on the deal and the spread I made,
Yeah, exactly. No, that makes sense.
Yep.
5 more minutes.
That's awesome.
So, but yeah, so some of the other things I'm finding is, Luke, you'll like this. So you're direct to seller.
Yep.
And you're having good conversations with your sellers. And what I'm finding is a lot of our direct-to-seller wholesalers companies are, hey, I'll buy your house. I know it's I can give you 200 cash or 300 with seller financing, right?
Yes.
And I'm going to give you no money down. I'm going to give you $1,000 a month until it's paid off, right?
I've been seeing a lot of that lately.
They're stuck in the middle. So I'm like, okay, well, how many people are offering 30, 40, 50% down?
None. Zero. I mean, if there's any, very, very few.
But how many loans let's use Chris as an example. Yeah. Would he lend you money with 30%?
Absolutely.
Position?
Right.
Probably, right? What's that?
Right.
20%.
Yeah. Hey, math works. It doesn't matter.
Right. No, it is. It's wild.
So got it. Now that you know that you can create this stuff, and you have an end buyer coming in with down payment, you're providing home ownership. You can have a 30% first, and whatever, an 80 or not an 80, but a 50% second.
Right. Well, I had a guy come into my office last week, and it was very interesting because it's very similar to what you're saying. So he was making calls, and basically what he was doing is he's offering on all these MLS deals. He's calling the agent and telling the agents that he'll, say that it's a house in Scottsdale for $600,000. He's coming in and he's offering like 680,000. Mm-hmm. And they're like, wait, what? Like, why? And he's like, well, it's got to be on terms though. I'm going to go no money down, but and then he'll obviously find out if they have low interest rate. And then he's like, well, if they're at a 3% interest rate, if they're at a 3.5% interest rate, I know that, maybe their payment is whatever that number ends up being is at, maybe $3,000, right? $3,200, whatever it is. He's like, well, I know in that area, if I'm looking at rents that I'll come in and I'll be able to rent that house out for $4,000. Mm-hmm. And so he's like, I'll just collect the difference. And so that's what we were saying. We're like, okay, well, but you're also buying it, $80,000 over what the house is actually worth.
Does it matter? Well, because he's getting 30 years to pay it off. Does he care?
Right. Exactly. No.
30 years. Do you know what that note's worth?
Yeah,
you know what that value that note is worth? Probably $300,000. That's what he knows. He'll pay him $900,000. It doesn't matter. It's whatever the cash flow is. It's whatever the payment is divided by any yield and loan to value that any note buyer would want. And so if he's smart, he'll get first right of refusal to buy his own note.
Yeah, it's wild.
That's
I was blown away. I was like, oh my gosh. I was like, that seems absolutely insane to do. But I mean, he's like, well, how I'm looking at it is, okay, if I throw it, I have a 30-year mortgage on it. Well, I know for a fact in 30 years, worst case scenario, that house is going to be worth more than 680.
He doesn't care because he's never selling it.
Yeah.
The only problem is that particular one is if that note gets called due, that's a bad deal, right?
Well, it depends what the value, what the note is too.
Yeah.
those are great with free and clear houses.
Yeah.
Then you just get access to that debt for those long. So I always, whenever I do when I get the seller to carry, I try to get a minimum of 10 years. So I have 10 years of pay down and all that. So think about it. If I get someone to carry a note at, let's just use that one deal. Let's say it was 280 and I bought it for 280, but I got it for 0%, sold it for 10. I mean, 10 year loan. Right. You're getting all that pay down. It's like, it's a good strategy. And so what I do is, my goal is I want to get some cash now, cash flow, cash later when it pays off. I'm just doing the same thing with a seller. Give them some cash now, give them some cash flow. Yeah. Pay out when it eventually pays off, or no lump sum, just payoff. Right.
Right. Crazy.
Yeah. Well, Eric, we appreciate it. We jump on these every Tuesday for 30 minutes. Thank you for bringing your expertise on the creative finance and how to make, sorry, I should have put in the title, how to make 30 up front and 50 over the term.
Yeah.
I do pay my buyer's agent. So if you're a buyer's agent and you have seller finance buyers, come along over here. You can see it. Go to creativedealmaker.com. That's how you connect with me. You can book a call. Go to we have every Wednesdays at 1:00 Eastern, we do something similar to this and with our group, and we go deep into how we structure our deals as well.
Okay, one last thing really quick. I want to try one more scenario here. Property in Prescott that we're looking at buying right now. Yep. Sellers just took it off the market because it was not moving. Needs some work. We can obviously come in and do that. I don't want to give the exact numbers because I'm trying to get this deal. I don't want someone else to come snag it. Okay, but let's just say they're asking 400, right?
400.
Say they're asking 400. And let's say that they will, it's worth 400. So they're asking 400, it's worth 400, but the reason it's not moving is because it needs some work to it. Just in the sense that they did an addition and it needs to be finished, right? They kind of got about a third of the way through. So we can come in and do that. Obviously, that's why it's not moving though, is because an end user who's going to buy that, it doesn't have 40 grand to come in and fix that up and, to finish it off, right? Or 60 grand to come finish off that addition. Mm-hmm. So I think, realistically, I think I could probably get it for, maybe 300.
Okay.
And so just curious, how would you approach this to the agent, to the seller? Because they just pulled it off the market. They had it on and it wasn't moving. And so they pulled it off. And so now you've got me thinking like, okay, well, maybe I come in at a creative aspect on this and try to say, hey, carry us, we'll finish this thing off. And then, try to figure it out.
What's your exit? Just a straight up flip?
I don't know. Be open, but most likely a flip.
So let's say they give it to you for 300 and you go market it at 400 and you have a seller finance buyer that lives in the area that is able to do the rehab and fix up and all the cool stuff that goes along with it. And they give you 40,000 down and then you wrap it and do it that way. And then keep them in there you might be able to keep them in there or just take them out. You just find out what their cash number is,
right?
Or their seller finance number. Maybe give them 100 down, and then right. they carry the difference over the term, because whatever they carry, that value of that is so powerful because you're obviously going to offer them the least amount of interest in the longest term possible.
Yeah, for sure.
By offering the least amount of interest in the longest term possible, then if and when that property ever sells, guess what you can do with their note that they created for you? You can move it to other assets. And so that's another little tip that it's substitution of collateral. So
interesting.
That's a tip on that. So I would just find out what their numbers are and what kind of income.
Find out what the interest rate is that they're currently paying. Find out what they owe.
Yeah.
How long they'd carry.
And then you don't know. How do you know that there's not someone in that market that would like to have a home ownership, that does want to put equity in, so you don't have to do it. Let them do it.
And just sell it to them at 10 or 11%.
Mm-hmm. Mm-hmm. And here's the other thing: if it's free and clear and the seller will carry, you can be more aggressive on your interest rate because you don't
exactly.
You're not worried about selling the note or anything. You still credit first and second.
I can set my price anchor low at 1.5% interest.
Yeah. Hey, here's what I do. I always say, hey, you front by giving me this premium price that you want, you're just front loading your interest in there. So that's why I'm just giving you principal only payments.
Yeah.
Or I call them equal payments till paid in full, something like that. So
okay, let me see what I can do.
yeah,
If I can work something out, I'm gonna have to give you a call and say, hey, where do I go from here?
yeah, cool. Well, I've got opportunities for you guys, so I appreciate you having me on the podcast here. This is great.
Absolutely.
Well, it'll be on all the YouTube channels and the Phoenix REIA channel, and yeah, I mean, it gets views all over, but you know, a few hundred people watch it for sure. So
heck yeah.
I thought it was like millions.
No,
I think didn't you, Chris? I thought you meant to say.
I just got new haircuts. Can you tell? No, just kidding.
Heck yeah.
Well,
awesome.
cool.
That was great.
Thanks for jumping on, Eric.
All right, we'll see you guys. Appreciate it.
Appreciate it. We'll see you.